Thanks for watching, everyone. For our latest Artemis Live video interview, I'm delighted to welcome Damian Sealy from PwC. Now, Damian is the Actuarial Leader at PwC in Bermuda and also for PwC across the Caribbean, and he's got more than 18 years of actuarial experience, having worked at PwC since 2016, first based in the UK and then moving to Bermuda for the company in 2019. Damian leads the delivery of actuarial services for PwC Bermuda and the Caribbean's audit and advisory engagements as well. And during his career, he's worked across the full range of insurance entities from captives to large global property and catastrophe reinsurers, as well as collateralized reinsurance structures in Bermuda. Welcome, Damian. It's great to speak with you today.
Thanks for having me, Steve. It's great to be here.
So today with Damian, we're going to explore issues related to the actuarial work that him and his team do in the market, as well as what he's seeing in ILS and collateralized reinsurance. And first, Damian, perhaps you could speak a bit about some of the market conditions you're seeing from your point of view.
Yeah, thanks, Steve. That's a good place to start. I think conversations around amongst actuarial teams, be it in an advisory setting, consulting or audit teams, or between actuaries and their boards, continue to be centered around the hard market conditions in P&C insurance sector, and the impact these conditions are having on in a range of areas. We have underwriting, reinsurance, the assessment of capital, and of course reserving. As actuaries, we want relevant and we want reliable historical data, and lots of it ideally to alleviate any credibility concerns. But bucketed in homogeneous groups, I know I'm asking for a lot, right? But we take that, we analyze it, we identify trends, and we determine assumptions in order to estimate the financial impact of future events, right? But the key concept underlying that is the past is a good predictor of the future. But is it, right? There are two factors that I'd like to highlight as we think about conditions in terms of actuaries' ability to simply use past data to estimate the future. And I want to start with inflation. General inflation levels have increased markedly in 2022. They continued into 2023 and this year as well. But inflationary indices reaching well above the levels that we've seen in the last decade, if not more. General inflation has been cited as a cost concern, contributing factor to the adverse prior development that we've been seeing in reserves. And this heightened inflationary effects impact unpaid claim estimates to the extent that the cost of disposing claims are impacted by inflationary effects, particularly, as I alluded to earlier, if that past inflationary conditions are different from the future inflationary conditions, and sometimes that difference is implicit in the data. That could present a challenge to estimating those future unpaid liabilities. Now, what are companies doing in respect to this? Many of them are attempting to quantify the impact of this excess inflation on the claims estimates. I'm seeing explicit reserves estimated and held in respect of this excess inflation. Now, what are some of the key underlying factors contributing to the heightened inflation? Many would say COVID-19, of course, got the ball rolling as a result of the impact on supply chain disruptions, and that's seen as a leading cause. But this brings me on to my second area that I would like to highlight, and that's geopolitical risk, right? Notably, a key contributing factor to the significant increase in insurance industry losses. We have the ongoing conflict in Ukraine, between Ukraine and Russia, commencing back in early 2022. The war between Israel and Hamas starting late last year. War continues to be a significant impact on the world economy and the insurance business. The affected lines, yeah, they're far-reaching. I mean, of course, war and political policies, but of course also marine, property, aviation, credit. It's difficult to identify any lines of business that are immune to the effects of global instability caused by these events. These situations are still active, still developing, and a cause for significant uncertainty. Now, staying with that theme or question of is the past a good predictor of the future, geopolitical risk also takes a very interesting shape, right? It was noted that in 2024, this year we'll see a large number of national elections held in almost 100 countries. And some of the most populous countries, home to half the world's population, that's 4 billion people. So whilst that, and that's happening whilst actuarial estimates, don't typically anticipate extraordinary changes in legal and social and economic environment, which may affect claim experience. So naturally, however, these elections are likely to have an impact on the country's political futures and collectively shape how things are governed in the world.
Thanks, Damian. That really lays out the current situation very well, and it's obviously a volatile environment everywhere around the globe these days. But what does all of this mean for the loss trends, and what are you seeing across the market that's notable at this point in time?
Yeah. So we here at PwC, we've conducted a study of the P&C insurance data across the US P&C market, sourced from over 2,000 individual companies, basically their statutory statements, Schedule P. And what we saw is that the whole US market has had favorable development. And for a long time, in fact, the US market has released reserves in each of the last 18 calendar years, including over 2 billion in 2023. Now, notably, workers' compensation continues to be a significant contributor to this aggregate favorable development, recording in itself over 2023, 6 billion of favorable development. And that's consistent with 2022 as well. The overall impact of the favorable development has decreased, however, to about maybe less than 1% of improvement from initial estimates across most accident years, with the favorable benefit of the same workers' comp offset by the adverse developments that we're seeing in other commercial liability lines, notably commercial auto liability and other liability occurrence as well, particularly in those soft market years of 2016 to 2019. But it's also evident in more recent accident years as well. Interestingly, our study also indicated that since the 2000 accident year, 2019 is now the first year to experience cumulative adverse development since its initial recorded loss reserves. And it should be noted that 2018 is not too far from being a second year to experience that. Turning our attention to rates, the CIAB, the Council of Insurance Agents and Brokers, reported commercial premium increases for the 25th consecutive quarter in the last quarter of 2023 across most lines, including commercial property. But that's indicated some softening, while you have workers' comp decreases continuing in contrast, obviously, to the favorable development. Rate changes for D&O and cyber coverage range from flat to negative. Rates are also somewhat down for D&O professional lines. But you should note that D&O experience has been decent. And when the markets hardened, the rates went up. But now we're seeing that coming back down somewhat. Now, outside of those pockets of rates are still probably good and probably still perceived to be in excess of loss trend. But it's probably getting close with general and social inflation continuing to support loss cost increases across most lines in 2024. So the question is, how long can the market continue to sustain rate above trend? I think that's the big question for 2024. I think in terms of the adverse development, I'm not sure there's strong signs that will abate in 2024. I don't think the US market necessarily has its arms around what's happening in casualty. But that's what I'm seeing as far as trends and how the development is going.
That's really interesting. And when you talk about adverse development, I mean, given your P&C focus and the fact we've been in a hardening market for the last couple of years, it'd be interesting to know whether you see decisions that were made by underwriters when the market was still soft manifesting within reserving and reporting.
It's a good question. Interestingly, when I moved from the UK to Bermuda back in 2019, not only did I trade an umbrella for Bermuda shorts, but I also traded practicing in a soft market to a hard market. It's fair to say that the reserving cycle, it exists. Various research studies of insurance markets historically have shown that the final estimates have tended to be underestimated in bad years and overestimated in good years. The under and overestimation observation historically generally following the profitability of the insurance cycle. During my, let's call it UK P&C years, i.e. the soft market years of 2016 to 2019, there was a deliberate and consistent messaging throughout the insurance market. From the regulator to CEOs to actuaries, the message was clear. In previous markets, there had been experience of underestimation of reserves. Therefore, current soft market conditions must be accounted for when reserving and provisions made for effects on reserve risk. There was also an increased expectation on reserving actuaries to challenge the optimism that might be coming through from other parts of the business, particularly pricing, underwriting, business planning. Looking back at some historical articles from that time, I do recall a graph of historical ultimate loss ratios and the development from 1997 to about 2014. This is of Lloyd's casualty business. And the graph showed peaks around the turn of the millennium, 1999 to 2001, and low troughs around 2003 to 2005, and rising again through the financial crisis of 2008. The cycles, of course, coincided with the soft market period of 97 to 2002. There was then a hard block from 2002 to about 2006, followed by some distortion amongst financial crises, following on peak years from 1999 to 2001. It could be seen that the loss ratios from the second year of development to the current estimate, that was some 15 years later, had deteriorated by some 50%, 50. All in all, I believe the market was trying to do the right thing, especially smooth those peaks and troughs as much as possible. Many of the questions and considerations of a soft market do apply in a hard market, right? At the time, there was focus on understanding the business processes. For example, understand the underwriting changes. There'll be changes such as changes in terms and conditions, underwriting, selection, the mix of business. But these considerations also apply in a hard market. The considerations around the reserve strength and any changes over time, reflecting both the actuarial estimate and the management margin. But again, we think about those in the hard markets as well. They're also focusing on the loss ratios that were used, if they were on level, to determine your initial expected loss ratio estimates. Did they include a block? Did the recent period include a block of loss ratios in a soft market or a hard market? It was important to select the most appropriate cohort to represent the expectations of the future ahead. And again, we should be thinking about those in a hard market as well.
Great, that's a really good explanation of what you're seeing there. So what are the specific issues that are getting highlighted at this point in time by actuaries and reserving teams, and how are those communicated to boards?
Good question. Actuarial teams, reserving committees, Steve, I think they're doing more. And by more, I mean more sensitivity analysis, more scenario testing, importantly, a consideration of a wider range of possibilities, simply because there's significant uncertainty in this environment. Of the areas discussed earlier, let's take inflation, for example. In order to quantify the impact of the ongoing heightened inflationary environment on the estimates of unpaid claims, first, actuarial teams are compiling historical data from various inflation-related indices, and that includes CPI, used cars and trucks, wages, medical cost inflation, cost of goods sold inflation. And they're also including proxy allowances for social inflation, which, as we know, is not as measurable as those other indices. And they make selections on historical and future rates of these indices with the expectation that the heightened inflation environment will subside in an assumed number of years. Now, they're deterministic approaches, which consider various industry sources, whereby actuaries estimated the sensitivity of the loss costs for each line of business to each of the selected inflation indices. And they create sort of a weighted index of those future rates for each line of business. But other methods could be the use of stochastic analysis and simulations, and using tens and hundreds of thousands of simulations. Now, whilst it's important for actuaries to produce a robust central estimate of the unpaid claims costs, it's just as important for reserving teams to demonstrate to their boards the variability in those estimates. So if we think more from the recent study that we conducted, and if we concentrate for companies that recorded reserves greater than 500 million, and we looked at the percentage of companies whose year-end reserves, when re-evaluated at the end of 2023, had hindsight reserves within a specific range or percentage difference from the initial recorded amount. What do I mean by that? So, for example, within 5 years, i.e. your year-end 2018 reserves, we had 61% of companies showing hindsight reserves that were within 10% of the initial recorded estimates. Now that percentage reduced to 52% of companies within 9 years, i.e. using their 2014 reserves. Now let's step back and consider even a wider range. Now you had 12% of companies whose hindsight reserves differed by more than 25% within 5 years of initial reserves. This percentage increased to 17% of companies whose hindsight reserve differed by more than 25% within 9 years.
So there's a lot of information. There's a lot of information coming into these companies, obviously, from the actuaries and the reserving teams then.
Yes.
But what are they doing about it? How are they putting this insight to work? Is it leading to transactions, or is it perhaps more about how companies can evolve going forwards to try and ward off any such issues across market cycles?
Yeah, no, that's a good question. I think it's more towards the latter. I think one of the main trends we've seen here is a need for speed. Companies are trying to be faster. They're trying to complete their analyses quicker through automating the reserving process, for example, and being able to produce indications of that are updated quickly and see if change and really see and understand the changes in the experience. You can see it coming through your results faster, so you can react faster, you can reserve for it faster. And if you're pricing actually, it applies to them as well, right? Whereby they're able to produce updated indications for what they think the current year is doing a lot quicker. And this is important. If you're only monitoring your pricing, say, once a year, there's a chance you can miss 3, 6, even 9 months of experience that they may have wanted to take into account. That might have caused you to change how much rate you're even trying to get. So we see companies pushing their actuarial modernization agendas, trying to be faster, trying to ensure that they have good rate monitoring capabilities, so that when they actually have a good sense of those movements. As you write new policies, obviously limits change, attachment points change, prices change. It can be pretty hard to assess whether or not your pricing is improving or deteriorating. But companies, well, some companies are making investments around just trying to know that better, and so they can be appropriately reactive to the price and ensuring that they're trying to get what they can really get in order to maintain their loss ratios. We do have clients where we're trying to We're trying to help them expedite their reserve review process, reduce their pricing indications lead time by moving to the cloud environment. Now, these clients leverage cloud platforms and bring data straight from the source systems to web app solutions and summary dashboards, therefore leveraging the power, the speed of cloud computing, just to be quicker. The idea of leveraging the cloud, the speed that you can get from that and using that to produce better indications faster, that's the push that we're seeing.
Mm. No, that's really encouraging to hear. I mean, modernisation has been a theme really through my nearly 30 years of covering the reinsurance industry in general, but it's really picking up pace at the moment, and good to hear it's happening in the back office and with the reserving teams as well. But with that new tech, are you seeing a role for sort of artificial intelligence and things like that as well?
I believe so. I think a lot of firms, ourselves included, we are recognizing that that is where the world is moving, and it is understanding that it, like others, it's a tool that we should utilize to improve the output that we're producing. So it's certainly being embraced.
Mm. No, that's a really sensible way to approach it as well. Now, if we maybe change gears a little bit and turn towards the ILS and collateralized reinsurance market, given that's the area the Artemis audience is so interested in, how is this area holding up, and what are your teams doing to assist with those structures?
I'd say the ILS and collateralized reinsurance market is doing better than holding up. It's growing. It's actively growing. For my team specifically, we're certainly seeing an increase in the number of new formations requesting our actuarial support, whether that's directly providing advisory support where we are independent of the new vehicle, or as the actuarial team member within the overall audit team. The level of actuarial support is, of course, dependent on the nature of the underlying coverage. During the earlier part of my Bermuda journey, I would say there was perhaps a higher concentration of property catastrophe coverage within my portfolio, where vehicles were established to protect insurers, for losses against hurricanes and earthquakes and other large disasters. One of the primary features I believe attracted investors to property cat reinsurance resulted from the short-tail nature of this coverage, as opposed to casualty, leading to a relatively certain result known quite quickly. But what I've seen recently, however, are a number of structures, CIs, collateralized insurers and reinsurers, sidecars, where the underlying coverage relates to casualty business, and some also providing coverage across the market, property cat, casualty, specialty. We of course focus our assistance in helping clients to, or in the case of audit, where the audit team is essentially my client, we're trying to help them to understand the sensitivity and the variability of that result. So in terms of the fair value measurement, when we're thinking of collateralized reinsurance, the insurance assets and liabilities are relatively illiquid compared to other industries, and so necessarily reliant on expert judgments. The lack of a trading environment for insurance companies results in the need to create sort of hypothetical models for estimation that are subject to a high degree of judgment, regarding the model, regarding the model inputs, regarding the assumptions. And the assumptions are many, including the interest rate, including risk adjustment rate of return, the required capital charges, the payment patterns, and of course, the starting point itself with even those payment patterns, the undiscounted reserves are themselves an estimate. So in addition to the fair value, adjustment is subject to variability from the financial markets, economic conditions, accounting standards, changing geopolitical risks I mentioned earlier, as well as just simply the industry best practice may have changed.
Mm. Oh, that's really interesting. I think as the ILS market has been shifting towards some of these P&C and casualty structures, it really has opened up a whole new area where the industry needs expertise and support, particularly when you think about how cash flows, etc., are so different in that class of business compared to the peak property cat that really the industry was built on. Are you expecting to see sort of additional growth in those areas, do you think, around casualty and other types of P&C risk?
I certainly do. I certainly do. Especially as the industry and as the market and with the support of actuaries continue to explore the impact that tail risk and that longer term variability can have, it can be positive if understood. So I do think that it's particularly a growth area, and I'm glad to see the market giving it consideration and expanding the support that it can lend to the industry.
Yeah, I think the introduction of third-party capital there is going to be good for the insurers at the end of the day.
Absolutely.
Okay, so finally, let's look forward towards the year end. How do you see things evolving, and are there anything in specific that comes to mind for the sort of end of year renewals? And what do you think it means for the use of alternative capital by insurers and reinsurers as we move towards 2025?
So at this stage, I don't see any signs of the growing usage of alternative capital structures abating. What is evident, I think the improved efficiency in a lot of these structures has certainly been welcomed by the market, and at a time when it is possible to capitalize and maximize investor returns during these hard market conditions. What I would say as we look to year end and into 2025 is let's keep an eye on the impact of natural disaster events. We've seen a couple of years of relatively benign conditions, and to be clear, insured losses still exceeded 100 billion for those years. But however, with the exception maybe of Hurricane Ian back in 2022, global events individually resulted in losses in single-digit billions. Yet, here we are at the start of summer, and we can already speak of the effects of a Category 5 hurricane, namely Beryl, which barreled through the Caribbean, taking a somewhat unusual southern route, and thus unprecedented in many, many ways, including strongest hurricane in June on record, strongest July Atlantic hurricane ever. Now, thankfully, the reinsurance industry is not showing a shortage of capacity at this time. It appears to be keeping pace with the industry's demand and importantly, its ability to respond in times of need.
Thank you, Damian. Yes, that's good to end on a reminder of the unprecedented nature of Hurricane Beryl and what the forecasters are predicting for the coming months. So look, thank you very much. I really appreciate you sharing your insights into PwC's actuarial work in Bermuda and beyond. Great to spend some time with you today.
Thank you, Steve. It was great to be here, and thanks for your time as well.